Hey, it's Michael Saul, but everybody calls me Tiny. This video is Kanye 79.8 and a long in the tooth bull. What could possibly go wrong? This is stock market analysis for the week of July 30th, 2018. If you would like to receive intra-week updates, go to www.attackthemarkets.com, put in your first name, your best email address, follow the directions that follow, and you're all set. You'll start to get intra-week updates from me. If you would like to join the Facebook group, www.facebook.com/groups/attackthemarkets, answer 3 simple questions, and you are in. If you never want to miss a video from me, hit subscribe and then hit the bell so you are notified. Don't forget to give me a like and leave a comment if you like what I have to say. All right, so let's take a look at the market. I did not do a video last week because we were just kind of coiled up right on the 78.6% retracement. If you've watched my videos before this one, you know that I am looking for us to go up to new highs, to break those highs. That has not changed despite Friday's softness. So let's talk about some stocks that went wrong last week, all right, or went bad last week, and we'll see, do a little analysis on them. So Facebook gapped down on Thursday and it looked really strong uptrend. I know a couple of people put out recommendations that Facebook was going to blow out and to buy calls. Again, this isn't to mock them, right? Lord knows I've gotten my amount of trades wrong and been on the wrong side of trades as well. Just saying, I just don't understand the gambling ahead of earnings. I just never and that's all it is gambling. Okay, I don't care how strong the trend is. It's just proof positive that it doesn't matter. Okay, earnings are a wild card. Anyway, the big gap down Thursday, and it did get a bounce, but closed just really barely above the open. But look at Friday. Gapped up and gave it all back and closed below where it closed on Thursday. So the question is, what happens from here on Facebook? I want to see it coil up a little bit and digest, and then see what happens. There is something called the 3-day unfilled gap rule, which says if a gap is not filled within 3 days, it usually continues in the direction of the gap. And you can see that all over Facebook, right? Here's 1, 2, 3, and then fill, continued. 1, 2, 3, and then fill, continued, right? It's all over the place. It's not 100%. Okay, sometimes it doesn't work. But like here, 1, 2, 3, didn't fill, but no. It wound up going back up. So it's just something to use as a background. But the fact that we're under the 200-day on Facebook, I really want to see what sets up here, because this could be ready for a further decline, maybe back down to the March lows here. All right, let's just see, though. I'm not calling that yet. I want to see what we do from here. Twitter. Now, Facebook got hit because they were saying usage was down and the forecasts and everything. Well, what they're trying to do is they're trying to get rid of the fake profiles. Right? Here's Twitter. Again, usage is down or not as many users, whatever it is. It's irrelevant. Okay, what the reason is, it's because it's not as popular as it has been. And that's the same thing with Facebook. That's really what it comes down to. And Twitter with a nasty gap down. This looks like if it continues, it could test the 200-day moving average at a minimum. And here's Intel with a nasty gap down off of a delay in their latest chip. So Intel kind of topped out back in June, came down, tried to get over the 50-day and couldn't do it. So that put some pressure on the market. Some of the high flyers putting pressure on the market. There was some geopolitical stuff. President Trump with Iran, of course, which was he stood up to Iran and said, hey, you know what, we're not going to get threatened by you. So that's always nice. And then there was some, it's nice. It really is. It's nice to have a president that has our back. And yeah, I'm a blatant Trump supporter, for those of you who don't know and probably don't care. All right. Anyway, and there were a couple of other things in the news, and that's what the title of this video is all about. So the first one is Kanye. So Kanye West, in case you didn't read, bought a basket of stocks for his wife, Kim Kardashian West, and it wound up beating the market by more than 40% since then. Netflix, Amazon are part of it, Apple, Adidas, and Disney are also in there as well. Okay? So what is this telling you? That Kanye is a stock-picking superstar? Maybe. It really isn't a disrespect to Kanye. More of it, of the fact that if this is the kind of stuff that's getting reported now, where rap stars and shoeshine boys, right? Not Kanye West isn't a shoeshine boy, but this goes back to what? Joe Kennedy, right? When the shoeshine boy is giving you picks, right? I mean, what's going on here? Kanye West is now killing the market, outperforming the market, right? So, what's up with that? That, in my opinion, is a giant red flag. Is it a shorting signal? Of course not, okay? You will get carried out trying to pick when complacency will end and where a strong bull will end, but it is definitely a warning sign. Not a yellow flag, not an amber flag, a red flag, okay? If this is news now, this is what we're reporting, how, even Kanye West can do it, right? And not knocking his intelligence or anything. It's not what this is about, okay? But he's not, this isn't his main business. Okay, so that's number one. Number two is, this is an article from CNBC, and it talks about Facebook and Apple followed Intel and Twitter lower, dropping 0.8 and 0.1. Okay. Thus far, over 50%, and this is as of, make sure it's Friday. Just want to make sure I get the date right. Yeah, Friday. This is as of Friday, that thus far, over 50% of S&P 500 companies have reported earnings. Of those companies, 79.8% have reported better than expected earnings, according to data from FactSet, which I trust is reliable. It doesn't make any sense why you would make that up. Right? Then another part of this, part 3, which is not in the title of the video, but we can also talk about the U.S. economy grew by 4.1% in the second quarter. And my good friend Mike Swanson, he reposted a tweet from somebody. Let me get that too. Hang on, let me pull. Okay, so this is from Fred Hickey. And you should follow him on Twitter because he's really smart. Anyway, investors may come to regret today's 4.1% GDP number ties the Fed's hands completely until stocks melt down. There is no net. In bubble-driven economies, the sequence always is. Stock declines first due to outflows from Fed tightening, recessions, and EPS declines later. I'm going to give him a like also. You should give me a like on the video if you like what you're hearing. Anyway, so there's something else, right, to also look at. And then, of course, the last part of the title of this video, which is a bull that is long in the tooth. I mean, the market has been just rocking and rolling for a pretty long time here. Again, is it enough to start shorting? Of course not. Of course not. It could be suicide to your portfolio trying to pick a top. But it also means not to get just, we're never going down. It's a paradigm shift. It's a new market. It's not. It's just not. I believe the S&P and the Dow will hit all-time highs from here. But after that, I believe, I've been talking about trailing stops the whole way. But, all right. Sorry, I got a call there. Anyway. I completely lost my train of thought there. That was a pretty long phone call, but what I want... So, let me go back. What I think is going to happen is the S&P and the Dow are going to go to new highs. I believe when they go to new highs, I think, there we go, about tightening stops. I've been talking about tightening stops for a while now. And, look, it's always good advice to protect profits and to, smoke them while you got them, for lack of a better word. Take profits going on the way up and everything, because you never know what can happen. And next thing you know, you're looking at a loss. And, yeah, it always comes back, but no, that's not the case, right? It doesn't always come back, meaning the market, okay? And the market can go into a prolonged period of sideways action or even the dreaded bear market. And let's forget about the market overall. What about individual stocks? Same thing. Right? They can get hit and not recover. Am I saying that's what's going to happen with Facebook and Twitter and Intel? No, I'm not. I'm not saying that's going to happen. But I believe that now is the time to really sharpen up your trailing skills and your discipline here. While I do think we're going to new highs, doesn't mean we're going to. That's just my opinion. Okay, there are a lot of opinions out there. Some people are saying that was it. I don't think that's it. I think we come back, retest the pretty good resistance level, which you could see from back here, and then here, and now here. I think we retest it, maybe even wash through it a little, and then I think we turn and we go to new highs. All right, here's the Dow. It's lagging. The Russell. Okay, so the Russell is more sideways than anything here. So you gotta, right, so you got, you know, this, there we go. And you can see it dip down out of this small range below the 50-day, but you really don't. Next support is really down here, and it could stay in that range there. Mid caps, similar. And the NASDAQ, which of course are getting cracked with Twitter and Intel and the Facebook, and putting some pressure on tech. I mean, Amazon gapped and crapped on Friday. And if Amazon would have missed earnings, who knows where the market may have gotten really killed. They're really looking at, the market's really using Amazon as the bell. All right, so let's look at bonds. You can see bonds, which a lot of people had called this a base, saying, hey, we're going to start a big rally. I mean, now it looks like it's coiled, and it actually may want to try lower from here. Gold, yeah, I mean, gold looks like it's coiling up, and it wants to go lower. Bitcoin, chart not shown, showing some signs of life. Back over 8,100 last I checked. So that's starting to move again a little bit. And then oil. Right, so we talked about the July 4th seasonal holiday high. Okay, since then that has called the high so far. It doesn't mean it has to stay there. It's only background. And right now we're getting a little bit of a bounce, but it doesn't really look impulsive. So if this starts to roll, look for a test of the 13 level and even the 200-day moving average, which the longer this takes, if it indeed does roll over, the 200-day could actually catch up. So here's the recap. Did the video a little bit different this week. Some pressure from some tech darlings last week. Kanye West seeing some really nice outperformance in the market. What does that mean? 79.8% of the stocks that have already reported earnings have beat. Lots of good news, but the market's long in the tooth. It's getting old. Okay? Geopolitical situation seems to be rocking and rolling. Looks like all the Russia stuff is so far blown over. But, I mean, the market climbs the wall of worry. If there's nothing really to worry about, can the market continue to go? Maybe just based on complacency. To me, I don't like picking tops. I don't like picking bottoms either, but I especially don't like picking tops because complacency can go on much longer than you imagine it can, right? What's the famous saying? I'll probably butcher it, but the market can remain irrational for much longer than you can remain solvent. I think that we'll probably pull back a little bit more. I like the previous break point here to hold the support, maybe dip a little bit down. But I believe the next time we turn should be enough to get us up to new highs. I think it's a good idea to trail stops. I think it's a good idea to take profits on the way up if you got them, right? Or hedge with selling covered calls or buying puts as a hedge or whatever it is. But you really shouldn't get flat-footed at this point. Okay? And just because it looks like we're going to go to new highs and the market's been strong for 10 years and all this stuff doesn't mean we have to. Eventually we won't, right? I mean, before we start the next bear market, whenever that will be, it probably won't hit a new high before it does that. Okay? So just something to pay attention to with that. Any questions, tiny@attackthemarkets.com. You like what you heard, give me a thumbs up and leave a comment. I'll talk to you in the intra-week email or in next week's video. Have a great trading week. Stay safe out there.